All right. So the topic of finding like a good company to invest in, that is always something that I'm thinking about. And, I'm looking for good companies to invest in that are going to be good in 2025, 2026. And I tend to have like a 5-year fence, right? Beyond 5 years, it's really hard to know what's going to happen in 5 years, right? So much has happened in the past 5 years, right? We had a massive pandemic. We had AI show up and really become super interesting, and stocks became really valuable. So I like to have like about a 5-year fence. So when we talk about long term, um, I tend to say long term to me means 5 years, and over time I will continue to reestablish, reset, what I think is going to do well in the future. So that would be kind of like my intent is picking something that's going to do well over 5 years. The definition of long term is 5 years, and it really starts for me with looking at a company and trying to find a high quality company, and a company that is, and I'm trying to find where I think I have it over here. So I was analyzing Union Pacific. So I'll use that as an example. So to expect that a company is going to do well in the future starts with really believing in their business, understanding what's their business about. And I think a railroad is pretty good example. We know the rail system is important, especially to move goods. In the United States, we're a consumer-based economy. We import a lot of the things that we consume, and they get brought to ports via ship, container ship, and then they get put on our rail system, and they get sent to these markets, which will then further break the bulk and distribute them out. So they are really important to the economy. And now when I look at a rail company, I see that they have really strong barriers of entry. Okay. And as you've seen in my videos, I put together this quadrant to kind of show the desirability of a business. And I put Union Pacific mostly in the green, just a little bit in the gray. And I'll explain why a little bit in the gray. Now, why are they mostly a desirable business is, you know, it's very hard to start a new railroad company. It's pretty much impossible. The tracks, I believe some of the tracks, certain rail lines have access to them, have a right to use them. And that's not very easily established. A new rail company can't come in and start competing against Union Pacific. They have to compete against existing rail companies, so that you can call it an oligopoly. But those types of business practices were set up more than 100 years ago when the rail system was established. So it starts with how to find a long-term winner. Well, first is for me is to understand their business, understand if this company has a lot of strengths and barriers of entry. They're best in class. They're one of the best operators in that industry. It's a desirable industry. It's not going to go away. It's going to continue to get larger. And for me, Union Pacific fits a lot of that criteria. Now, it's part of an industry that's been around for more than 100 years. And it's going to be around in 100 years, is my expectations. The good news is it's a very well-known industry. It's a very well-known company. The bad news is it's probably not going to grow, very fast. It's probably going to grow in proportion to the economy. It's going to grow through efficiency gains, like if they become more efficient in moving cargo from wherever they get the cargo and then to its destination. So all those things are going to be factors. But Union Pacific, in my opinion, is still a candidate as a long-term winner. It's just not going to be a long-term winner as a, potentially like a Uber or some small company that's just booming. Like ServiceNow is up 300% in less than 2 years. That's phenomenal. That's awesome. NVIDIA is up 20x in the last 2 years. Phenomenal, exciting. Union Pacific is not that type of company. But to answer the call of finding a long-term winner, we're looking at an established large cap company in Union Pacific. And it starts with understanding the business, understanding their industry. Do I expect Union Pacific's going to be doing as well as they are in 5 years? Yes. Do I expect the industry is going to be as good as it is today and probably better? Yes, I expect both of those. So that's where it begins. So once you identify, okay, this is a good company, now an important decision in investing is, am I going to get a good price? So now it's a matter of looking at Union Pacific and here's Union Pacific. So now that I know I like the business, I like the industry, I think it's going to have a prosperous future. It's going to have a positive future. I don't want to overpay because that could really compromise my rate of return. So Union Pacific, I've been watching for like 2 years, trying to find the right time to invest. And interest rates are down, so that's good for overall for stocks. This company in particular, I'm going to show the financials and then come back to the valuation. So this company over the last 5 years is up 35%, and they've paid a little over 2%, 2.33%. It's rail companies really hold their value because they're so stable and consistent. And it's hard to get in at a really, really good discount. The best discount we saw over the last 5 years was during the big fall in COVID. And ever since, and this stock's kind of been pretty consistent. It did have a pretty low price back in 2023. So it was a pretty good investment if you got in at that point. But now Union Pacific, I've been watching because I would like to have a railroad stock in my portfolio. I think it brings the consistency and the lower risk for a stock that I'm looking for. And I think it is going to be a long-term winner. Now, when I look at their revenues, you see that their revenues were declining in 2019. They declined in 2020. Understandably, we got hit by a giant pandemic. Okay, so a lot of things were kind of canceled. Like, hey, we don't want a bunch of stuff that isn't going to be needed. But then the economy really expanded quickly for them, and there was supply chain issues, so they were able to get more volume and raise their rates. So in 21 and 22, they had very good years, and then they started to have revenue losses in 2023. More recently, they have started to grow again, so that looks good. So this type of cyclical nature of their industry, that's kind of understandable. You have boom, slow down, and now it looks like it's going to begin to grow again. The company has been consistent, so I expect that right now they're at 22.8 billion over the trailing 12 months, but they have shown over time they have gotten larger. If you go back 5 years, they were 21.3 billion, but last year full year they were 22.5 billion, so they were a little bit bigger. All right, so that looks good. The company is expanding the revenues. It is a slow grower. It's not going to be a Meta that's growing at 20-25%. It's going to be a slower grower. But the market cap is 139 billion. It's really established industry, and you can see the premium there because you're actually paying about 5.5 times revenue for the company, which I think is a little high because it's such a mature industry. Your PE is 21. Again, rails get a premium. All right, so financials look okay on the top line. The cash flows have been consistent as well. When we look at free cash flow, you can see that they've generated cash flow every year. That makes them desirable to me. Again, I'm trying to find a long-term winner. So they're proving here that even during a pandemic, they're still cash positive. And that's one of the fundamental metrics that I look at is free cash flow. So this has been a very consistent company, growing, but at a slow rate, generating cash flow every year. So high level, I like the industry. I like the company. Their fundamentals look really good. Now, when I look at it, a specific valuation of Union Pacific, because I'm bought in on the company high level qualitatively, I think that they're going to have a good next 5 years. Now I want to buy the stock at a good price. So I do my valuation. I'm using the most current information available. They just closed a quarter. Their trailing 12 months did go up about $500 million. So that really helps the valuation. And I do a free cash forecast, growing at 5%, which is very reasonable for their industry. That's pretty much inflation plus 2 points. And then I get to a value of those cash flows, which is $7 billion. Add cash and take away debt, and I get to the company based on free cash flows is worth 176 billion, but their market cap is 137. So it provides a nice discount of 26%, considering that I think this is a quality company. And earnings per share wise, I'm using earnings per share for 2025, using a PE of 20, growth rate of 8%, which is lower than what analysts expect. And I get a valuation of 18% discount. So overall, I see a 23% discount on Union Pacific. So finding a winner starts with buying into their business, buying into their industry, doing the homework, then to buy at a good price. There's one more thing that I'm going to wait before I buy Union Pacific, and that's going to be the election. The election is a week from Tuesday, not too far into the future. The reason I'm waiting is I think if we have a president that is going to have a lot of tariffs, that may slow things down for a rail company, because if you have a lot of tariffs, maybe companies don't import as much. That could be a factor that could weigh on Union Pacific. So if that's the case, if like it's expected we're going to do tariffs, maybe Union Pacific stock drops another 10% or 15, and then I'll buy. I think I'm going to end up buying it no matter which candidate wins the presidency. But I just want to wait, because if I buy this week and then next week it drops 15%, I'm probably going to be kicking myself like, should have waited, should have waited 2 weeks, and then I could start dollar cost averaging. So that's how, I'll begin the conversation around trying to find a long-term winner is, looking at companies, try to look in places within industries that you really understand. That way you could make a decision or form an opinion about how their future is going to be over the next 5 years. And the rail business is not too difficult to understand. If you understand logistics, you're pretty much there. The rail system is part of the logistics system in the US. So let me stop there. Tomas, what do you think? What questions or points do you want to make?
And for now, I'm following perfectly. And so my question will be, it doesn't have to be a disruptive business to be a great compounder, right?
That's right. Your expectations need to be different, right? If you are looking at, let's say we're looking at a company like Microsoft, right? We know what Microsoft does. They're somewhat of a known disruptor. So is Microsoft going to double in the next year in value? Probably not, but they're probably going to do well. They're probably going to do well over time. Buying at the right price would be kind of a lower risk, lower rate of return stock. It's a positive company. But when we go to small caps, I showed Union Pacific as a large cap example. Now let's talk about a small cap, what we're looking for there, and how to try to find a winner that's really going to do well long term. Okay. So for that example, I'm going to use Uber. It's not exactly a small cap. So you know what? Let me pick a smaller cap. So I'm going to pick up United Therapeutics and tell you why I'm picking United Therapeutics. So they're smaller cap than Uber. Uber is already like 100 billion. United Therapeutics is a biotech company, life sciences. Okay. And they do certain medications and treatments for people that have these rare diseases, and they are profitable. They generate free cash flow, but they're doing something that's really incredible, which is they're actually in a laboratory growing human organs in a laboratory that will eventually be transplanted to somebody that needs, let's say, a liver. Let's say they need a kidney. They need a heart valve, which I'm not a life sciences person. I'm more of an accountant, software engineer type. But to me, that sounds like so incredible and useful. I think somebody that needs an organ, they have to be put on these wait lists. And if they don't get an organ, unfortunately, they die. And at the time that they're waiting for this organ, their quality of life is really compromised. So if these guys achieve that, holy smokes, it's going to be, very disruptive isn't the right word, more like transformational, or their solution is going to treat a lot of people. So it'd be very, very, very valuable. So why am I picking this company as a long-term winner? Well, to begin with, they have an established business, okay, that is growing nicely, right? They're growing, not the biggest business you've run into, 2.6 billion is their trailing 12 months, but they're growing nicely over the last years. So they have the combination of the established business is good. Now, this industry, I worked for a pharmaceutical device company for a few years as a controller, accounting controller, and I got to know the pharmaceutical industry. It gives me enough knowledge to know what United Therapeutics business is about, their industry. High level, I really believe in their business because their current business is doing well, but their research and development has a very ambitious plan. And if a couple of those ideas work, these guys are going to triple in revenue size over the next 5 years. It's just going to be huge. They may even get acquired by a let's say Eli Lilly acquires them. Eli Lilly is almost $1 trillion in value. They could easily pay 30 billion for this company, and stockholders like myself would be very happy because they're probably going to pay like a 60 or 80% premium overnight. Just boom. So this smaller cap has, in my opinion, the right ingredients to be a long-term winner. They have the current revenue that's profitable, current cash flow that's flowing. They have plenty of cash, no debt on the balance sheet, and they look good for the future because their research and development is generating ideas that could be that next push of value for the company. So fundamentally, that's where they're at. And Scott, I'm going to finish or go ahead, Scott, ask your question. You might be asking something that's relevant here.
Oh, well, thanks. I hope so. Yeah, I had a question just about the 2 or 3 industries you just mentioned. So, is it fair to say that transportation, right, industry, right, railroad industry compared to biotech pharmaceuticals, railroad industry will have the highest capex, and then biotech pharmaceutical will still have some, but not as high as railroad. And then if you want to add a third one, you mentioned Uber, so something like that, where it's more information, new economy, is probably going to have the lowest capex. Is that a fair statement?
Yes. Yeah. Yeah, it's a very fair statement because, a rail company is going to have to recondition the locomotives and the rail cars and even the track. They have to, service their tracks. And companies that have more intellectual property based businesses like biotech, like Uber, that's developing this platform where ride sharing happens, they don't have to invest as much more CapEx, correct? I would say that United Therapeutics, instead of having CapEx, they would have more R&D. And if we look at their financials, here's research and development, right? And research and development gets treated differently. It's always expensed. CapEx could be capitalized and put on the balance sheet, but research and development is expensed and put on the income statement. So this is a line that is a measure of a company. This is building the future. This is where they're putting money in future products that at some point will start generating revenue. If they're good at it, they're going to be creating new drugs, new treatments. In this case here, potentially artificially creating organs that would be transplanted to people. So that's the difference in biotech. All right, so let's take a look at this quadrant here. And I'm going to move United Pacific out of the way and just kind of use this as the company, right? This is United Therapeutics. So why do I really like this business? And I put them in the green. Is pharmaceutical biotech companies go in the green because when you develop a drug and you have a patent, then other competitors can't copy your formula/recipe that you created. They would be sued. When United Therapeutics successfully sued a competitor that tried to do that. And it happened a year ago. The judgment went in United Therapeutics' favor, and that is settled. So the patents on their drugs gives them very strong barriers of entry. That's why Eli Lilly is almost $1 trillion company. That's why you see other pharmaceutical companies with really high valuations, is because they have those barriers of entry. If they're a very smart organization and create the right drugs, they will be very valuable and be a long-term winner. I put United Therapeutics in the green. It's a very desirable company because their current drugs are protected and they're creating future treatments that will be protected once they get through the FDA process, the Food and Drug Administration process. So let's see. I think somebody wants to join the call. Let me let them in. It looks like Mike wanted to join. Welcome back, Mike. All right. So United Therapeutics, high level strategically, I really like the business. I like their ambitious, future. And if they can make that future a reality, this is going to be a great winner. And this could be like a 5 or 10 bagger, for me. So this is an example from us of, a winner that is more of a small cap. And the reason small caps could be really attractive is this company can really explode in value. If they go to market with these artificially created organs and the FDA says, yeah, you can start providing these kidneys to people that really need them. Without that kidney, their quality of life is terrible and they die. Boom. I mean, we're not that far away from it. People have artificial hearts. If you recall, that's been around for a while. Artificial valves. You have all these artificial things. United Therapeutics is just trying to make it more organic. They're actually creating things in a laboratory that would be organic as opposed to mechanical. So that's an example of a smaller cap trying to pick a few winners. With small caps, And my approach is to try to invest in maybe 5 to a couple more, maybe 7, and just kind of watch them operate, understand if they're getting closer to these ambitious targets. If they are, put more capital into them. If they aren't, maybe cut my losses and move on to the next one. So I have United Therapeutics is a good example for trying to pick a long-term winner. The next 5 years, I see that if they're successful with their R&D, this stock's going to do great. If they're unsuccessful with their R&D, this stock's probably just going to be about flat, but we'll know in the next 5 years. So that's a conversation around trying to pick long-term winners. What do you guys think?
And for me, everything's clear. I will try to find some small caps that fit the criteria.
Yeah, try to pick industries, that you can really understand, and start with your life experiences, your education. You probably can understand certain industries quite well. That's a great place to start, because you need that knowledge so you can understand it and probably have better ability to pick winners and losers, right? So, all right, good. So that's the conversation around long-term and short long-term winners. Let's talk about valuing banks and how that's different than typical companies. And when we value a bank, what comes in, so the reason we don't value banks like we do like Union Pacific, I'm going to show Union Pacific, then I'm going to switch over to Citigroup. So we have net income, we have depreciation, this is kind of a typical income statement. You have income, expenses, you have inventory, and then you have a profit. Okay, so you have gross profit, and then eventually you have net income. So that's a typical income statement. When we go ahead, Tomas.
Sorry, Chrome just closed out of nowhere. You were saying before about to invest in companies that I understand, right?
Yes.
Okay. Perfect.
Yeah. Good place to start. And then if there's an industry that you think, that's worth investing in, I'm going to go study the industry and learn it, and then I could be a better investor. But you got to learn it a little bit and then be able to invest. Okay, so we looked at Union Pacific's income statement. It looks like most income statements, but when you look at a bank, it looks very different. We start off right. Here's the income statement. Starts off with interest income on loans, interest paid on deposits, net interest income. It's like, whoa, this is way different. When I look at Meta or Microsoft or Union Pacific, it looks way different. And you're right, because a bank is really measured by how well they can lend out money at a high interest rate, and then they are borrowing money from their depositors. Their depositors come to the bank, deposit their money, and then they pay an interest to that person that deposited it. It could be as simple as a savings account, or it could be certificates of deposit, CDs. It could be bonds. It could be a variety of things. They could be paying on bonds that bank issues. So the differential is how a bank is measured. So we look at net interest margin. So with a bank, I do not look at free cash flow. If we look at the free cash flow statement, it's going to see how it has big swings, negative 73 billion, positive 25, 47, negative. So we don't use the statement of cash flows for banks. We do use earnings per share, and we use book value. So let me handle earnings per share first, and then we'll talk about book value. Earnings per share is just like looking at Meta or Microsoft or Union Pacific or Uber. How much net income are you making, and how much earnings per share would be provided to shareholders? In this case here, it's represented. We can value a company the same way using the earnings per share. But since we cannot use the free cash flow intrinsic value method for a bank, we instead look at book value. What is book value? And book value is theoretically the amount of money that would be paid to shareholders if the company was liquidated and after they paid off all their liabilities. You want the lowest lowest price to book value possible. And that makes sense, because if you had a 1-to-1 price to book, it'd be pretty much, that would be fairly priced. If you had a 1-to-5 book value, there probably wouldn't be any money left for shareholders. That'd be bad. So if you had like a price to book of 5, that'd be negative. there wouldn't be anything left for stockholders. If you had a low book value like 0.5, there would be a lot of assets left for stockholders if they were ever to go bankrupt. Showing this in practice, here's some banks that I've valued already. Citibank, this is SGKN, which is St. Galler and Cottonall Bank, which is, I believe, in Switzerland or Germany. And you can see that the price to book is
Sorry,
different.
which bank?
SGKN, St. Galler.
Oh, St. Gallen. Yeah, this is a Swiss bank.
Okay.
It's a Swiss cantonal bank, and I can explain what that means later.
Oh, perfect. Mike, you had a question?
Only a observation, and I cannot believe you didn't pick SoFi as one of your choices. Since
Next
that is
time.
one of my future growth stocks that I believe. Go ahead. Sorry.
Perfect. Next time. We could always add that one later. Okay, so we're looking at, these are all banks. This is an American bank, Citigroup, and then US Bank, Bank of America, Wells Fargo, JP Morgan. And then this is a Swiss bank. And this was a request from Scott, and I looked at it. Now, the metrics that I'm going to look at are book value, price to book. And you can see that the lowest price to book, the most attractive based on book value, is Citigroup. And then it's SGKN. Then US Bank is 1.43. Bank of America is above 1. The most expensive stock is JP Morgan. And JP Morgan, their stock has really gone up over the last 5 years. And that's great for stockholders, right? Their stock price keeps going up, but the company just keeps getting more expensive. The stock keeps getting more expensive. So that all is logical. And this is one of the metrics that I use on banks. It's something that other investors use. I think it's the typical way of looking at a bank. And when I look at the two forms, which is looking at their book value and earnings, and I know this is pretty involved, a lot of detail here, but there's no way around it. I look at the book value. I look at historically how they've operated. Here's the book value that they've had over the last couple of years. And then I try to project based on the growth rate that they've had over the last 7 years. I'm going to continue that growth rate, and I'm going to start with the book value they had in 2023 and growing it by 2.4% each year, kind of forecasting it out 10 years and looking at the present value of that forecast. So it involves a lot of like detailed information gathering and then trying to project where the book value is going to go and then trying to value that book value to today's value to establish what is the book value that I expect the share price is going to be worth today. And here it is. It's worth $95.15. And the current stock price, and I'll show that in a bit, is I think a little lower than that. And then I do, based on earnings, here's the earnings that the company's had, growing it at rates that I think are reasonable. And then I establish a value based on earnings. So look at book value and earnings, and then combine the two to form a blended, value, which is $84 per share, but the stock is being traded at $61 a share for Citigroup. So this is a discounted stock. If I look at book value, if I look at the earnings per share. Okay. And Scott, I think you wanted to know where I got book value information.
Yeah, I was wondering about that one just because it's it's a publicly traded bank, but I was just wondering where you got the data for that one.
Sure. So let's take a look at, so all this analysis here is in a different currency. Okay. It's in the
Swiss franc.
Swiss franc.
Probably.
Okay.
Yeah.
And everything here is in the Swiss franc. And the way I established book value was looking at their financials, and their financials over the last 7 years. You can get their assets, and then you want to deduct goodwill and tangible assets and take away liabilities and preferred stock, and then you get your book value. Okay. So the data came, it can come straight from the investor page for this bank, or it can come through like stock analysis because it was available there. And then you start, entering in the data, and then you'll get to your book value. The growth rates and so forth, that's really just a calculation of my data entry. So I could get to my growth rate. And then my book value per share the source was stock analysis. I looked at how many shares were available at the end of 2023, 2022, 2021, put those in here. And then I was able to get to a market cap at the end of each year as well. The book value kind of ranged from always being in the 90 cent, level, but on average, it's at 94 cents, 0.94. So that's where I got the data.
Okay,
Yeah.
I can't see completely all the details because I'm on my phone. But so how recent is your data here? The end of 2023?
Yes, the end of
Okay.
2023. I did not include anything in
Got
2024 because you want to see cleanly like a full year. So as we get closer to the end of 2024, the data starts getting a little old. And then once we get to 2025 and this bank closes their books, we'll have fresh data to work with.
So I don't want to interrupt if you still have more to go, but it might be relevant to give you a bit of the background on why this particular type of bank is a little bit special.
Okay.
Yeah, so with Switzerland, there's 26 cantons, right? You can think of them like states, more or less. And so each canton, for the most part, there's a couple exceptions, but most cantons have their own bank. And it used to be, they were all privately owned by the canton, right? So whatever, I mean, publicly privately owned, right? So government owned and not traded publicly. Now in recent years, they've been partially privatized. Not all of them. There's a couple that are still completely government owned. But so like St. Gallen and like Appenzell and Bern, Bern's one of the biggest cantons, they're still partly government owned, but there's a lot of shares that are float, right, on the private market. So that's why you will see some cantons the banks exist, but you won't find them on the market. You won't find their financials, but some of them you do. And the other part of that is it's quite unlikely that they will go belly up, right? Because they're government backed in a way. Now, it's not to say it can't happen. In fact, it did happen. The canton, so I'm in Aargau. Aargau, actually, I don't think is traded. I think it's privately held, or sorry, government held. But the canton of Solothurn, the one to the west, that bank did go belly up 15, 20 years ago. And that's why there's no cantonal bank of Solothurn, if you look for it. However, I think one of the reasons they started going private was to help try to avoid that, because now they have to publish, right? If they're publicly held, they have to publish, and there's more, I don't know, I guess, accountability and responsibility. But still, I would say it's fairly unlikely that they will go bankrupt.
And in Switzerland, totally. Are the banks also, like in the United States, we have FDIC insurance that if a bank were to go bankrupt, the account holders are protected up to a certain value. Does the same thing exist in Switzerland?
Absolutely. And I'm not sure what the level is. I think it's similar. But yeah, a country like Switzerland, if they weren't offering something like that, I would wonder what's going on. I would have to double check the numbers for you, but absolutely. Yeah, it's funny because I'm actually with Migros, so I'm with it's actually a private equity bank. Like you won't find Migros publicly traded either, but it's not government backed at all. It's a private equity bank, and so sometimes I wonder if I should switch to the cantonal bank because it might be safer. So
yeah, perfect. Yeah, so again, banks, I know that it's pretty involved. It's a lot of detail, but this is the way to value banks, and got a lot of data entry to it. But they are different, and they should be treated differently. But hopefully, you understood what book value is about. If you're going to invest in banks, get very familiar with book value and why it's important. Earnings per share, get very familiar with earnings per share because that's going to help you with any company that you're touching, whether it's a typical company like Microsoft, or it's a bank, or it's a real estate investment trust. Earnings per share is a very known factor, and valuing based on earnings per share is a very known method. Valuing companies based on earnings per share, some investors do not touch it. Like Charlie Munger, the late great Charlie Munger, never touched it. He didn't like it. He felt that earnings were, or the income statement is too manipulated by the management team at that company. And I think he's partially right. But I happen to bring it into my evaluations because, and I think that earnings per share does represent, is the company, selling enough, making enough money in that period. And you can see consistency. If you see like a 5-year run of earnings per share, and they've been very good earnings for a long time, like back to Union Pacific, right? Let's see how consistent they've been with their earnings per share. You could then say, hey, earnings per share is a very good, measure of how good the company's doing. Here is Union Pacific. This is why they have such a high price for their company, is they've consistently been a good, profitable company. $7.91 per share, $8.38, $7.88, $9.95, $11, $10.45, almost $11. That consistency in earnings per share is a very good measure of the quality of this business. Okay, so I still look at it. I still use free cash flows as the principal valuation method, but I still like to look at earnings per share. So, all right. So we took on how to try to find long-term winners, the differences in valuing banks. And I took a note, Mike, that maybe SoFi can be put into the bank analysis. I think that's a good idea. That's a high growth bank, financial services company. All right, good. So I think at this point we could, any other topics you guys want to talk about? If not, I'll probably wrap up the call.
Oh, you hit everything that I wanted. Thank you, Victor.
Yeah, you're welcome. And then tomorrow I'll be on again. Tomorrow I'll bring a couple of topics that I wanted to go through and probably be around some stocks that are making the news and are coming up. Next week we have humongous earnings calls coming. Microsoft, Google Alphabet, Amazon, Meta. there's these huge companies. So I'll probably be giving a preview of some of these huge earnings and where these companies are headed. And more importantly, you know, if they announce positive or negative, what does that say about that particular industry, the economy, and so forth? I think that'll be interesting to talk about tomorrow. All right, perfect. So thank you so much for joining, and thanks for all your support. Look forward to seeing you on the live streams as well as tomorrow. And let me wish you a really nice Saturday. Thanks for tuning in today.
Thanks.
Thank you. This was very good.
Thank you, everyone.
Yep.
All right,
Yep.
see you
Have a
guys.
good one, guys. Cheers.
Bye-bye.